Just few days ago, Levi Strauss and Corporation reported their Q3 financial results. And since they announced the results, the stock price dropped over 10%. So let's see, is Mr. Market offering us a nice deal, or is it a company which we should avoid? Let's start with the recent results. Cash and cash equivalents are down quite substantially from 810 million to less than 500 million. But at the same time, the long-term debt is also going down from over 1 billion to 963 million. The revenue and income is slightly up if we look at the 9 months ended. And they also bought some of their stock back. So the results are not exceptional, but not bad by any means. So why did the price drop? Well, because Levi's cut the 2022 profit forecast. The company now expects profit of $1.44 to $1.49 per share, compared to prior forecast of $1.50 to $1.56. And all this due to lower demand for more expensive products, which is understandable in a time of high inflation and a lot of financial problems around the world, especially in Europe, where they had a decrease in revenue by 39%. So now that we know why the price fell over 10% in the recent days, let's take a closer look at the company. First, let's see who invests in Levi's. So, insider ownership. That's a check. It is an incredible 55.3%. And it is mainly the Haas family. And Levi Strauss, the founder of the company, had no children, and he left the business to his 4 nephews. And nearly a century and a half later, it is still mostly owned by the nephews' descendants, the Haas family. Insider buying? That's an X. Insiders in the recent months are selling the stock. And super investors, that's a check. 2 super investors own this stock, but only in very small amounts. It doesn't go over 0.05% of their portfolios. And super investors buying, that's an X. They were not buying in the last quarter. Okay, so now let's look at the financial health of this company. Return on invested capital. That's a check. It is 15.4% in the last 8 years. This is nice because we are looking for a number higher than 10%. And what about free cash flow growth? It is also a check. It is a 20% growth in the last 8 years. And like with return on invested capital, we are looking for a number higher than 10. So we get double that. And that is really, really good. And what about net profit margin? That is an X. They have 9.1% net profit margin, and other companies in the sector are around 13%. So Levi's doesn't have a lot of pricing power. And what is happening with shares buyback? That is an X. 4.3% more shares were issued in the last 8 years. So investors are owning a smaller piece of the company, even though they have the same amount of shares. Let's take a look at the debt. That is also an X. It would take over 2.5 years with the 5-year average free cash flow to pay their debt. And we are looking for a number lower than 2. Because that shows us that the company can fairly easily pay their debt back. Okay, so it is a mixed situation with Levi's, but before we find the intrinsic value, let's take a quick look at the dividends. Dividend yield, that is a check. It is 3.4%, so a quite nice dividend yield. And the payout ratio, that is an X, it is 5.1%, so it is a bit low because we are looking for a payout ratio between 30 and 50%. But lower payout ratio doesn't have to be a problem as long as the company is growing and using this cash to expand or to buy back shares. And what about dividend growth? That is also an X. And that's because Levi's has been paying dividends only for around 3 years, and they tend to go up and down between 0 and 48 cents per share. So we just don't have enough data about the growth of dividends. Okay, so now that we know a bit more about this company, let's value it using a discounted cash flow formula. And for this valuation, I decided to use a 5-year average free cash flow because 2021 free cash flow was really high compared to the recent years, and it is very unpredictable. In 2020, they had a loss, now a big gain, so it seems like a good idea to average things out. So we will have to estimate the growth of Levi's for the next 10 years, and we will make 3 scenarios, a low, medium, and a high one. So for the low scenario, we can estimate a growth of 3% for the first 5 years and then 5%. For the medium scenario, 5% growth for the first 5 years and then 7% growth. And for the high scenario, in which we believe that Levi's is going to do really, really well, for the first 5 years, 9%, and for another 5 years, 8% growth. So with these estimates, what is the intrinsic value of Levi's? Well, in the low scenario, the price per share should be around $12, in the medium around $14, and in the high scenario around $17. But of course, these are not the prices we should be looking for because we always have to add a margin of safety, and I use a 30% margin of safety. So if we include the margin of safety, we should be looking for prices like $8.30 in the low scenario, $9.70 in the medium scenario, and $12 in the high scenario. And the current share price is $14. So it is almost all red. And we are still missing around $2 to get to the high scenario when we include the margin of safety. So it seems that Levi's is still a bit overvalued even after the recent drop. And even though they have some things going for them, it is, well, nowhere near a no-brainer as an investment, at least for me. But if you want to invest in Levi's, then please consider this analysis only as a beginning of understanding this company, and always do your own due diligence. So that's it for today. If you found this video helpful and interesting, then please press the like button and subscribe if you want to see more videos like this one. Thanks again, and bye-bye.